Lesson 7, Investing Strategies. Which one is right for you? Hello and welcome to Lesson 7 of the BetaShares Investing 101 course, Investing Strategies. In this episode, I'm going to explain a few different ways you can approach investing. Now, don't be overwhelmed by the options. You may find that your investment style or strategy is a combination of these, especially over time as your financial goals change, as you grow older, or perhaps as you learn more about investing. Ultimately, your choice will likely come down to a few things: your time, dedication, or how hands-on you want to be with your investing, how much you're willing to spend on fees, and the level of risk you're comfortable with. Let's start off explaining the two main philosophies when it comes to investing: active and passive. Active investors try to identify good companies or other assets to invest in, with the aim of outperforming a broad market index. For example, the S&P ASX 200 or the S&P 500. Just remember, stock picking is more difficult than it seems. Picking individual investments requires lots of research, confident decisions, and typically involves higher risk. This is why many active investors choose to pay the experts, professional active fund managers, to pick stocks or other assets on their behalf. If you pay a premium for experts to pick your shares, then they should provide you with better returns, right? Well, maybe not. In 1973, Princeton University professor Burton Malkiel claimed in his best-selling book, A Random Walk Down Wall Street, that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. So essentially, a chimpanzee could select stocks just as well as a professional fund manager. If you want to invest your money in shares, but don't have the expertise or time to select specific companies yourself, and you think active managers are too expensive, what are you to do? Passive investing. Passive investing, usually by investing in an exchange-traded fund or ETF, is a popular option. It's seen as a cost-effective way to invest and suits those who would rather take a more of a set-and-forget approach to investing. A passive investor typically has a buy and hold mentality, trading minimally with the goal of building their wealth over the long term and ignoring short-term setbacks or market downturns. Their aim is to track the performance of a broad market index rather than trying to beat it, in anticipation that the value of their portfolio will appreciate over time. So, we've covered active versus passive investing. Let me explain some other key strategies you may want to consider. A growth investor's goal is to profit from the increasing share price of companies. If you're in an earlier life stage, or if your goal is to increase your long-term wealth, you could consider yourself a growth investor. An income investor's goal is to create an income stream from their portfolio. They look for companies that pay high, regular dividends. Income investors also typically invest in fixed income, also known as bonds. You'll likely be an income investor in a later life stage, looking to take less risk and earn income. Value investors also aim to profit from the increasing share price of companies, but they seek to maximize returns by finding shares in the market that they consider to be undervalued. Value investing requires a lot of research and careful decision making, but the effort can be rewarding. Responsible investors tend to screen out companies that don't align with their ethics, such as those involved in weapons, tobacco, alcohol, and gambling. Or they may positively screen for companies involved in renewable energy, climate change impact, or those making a difference in gender diversity.